Hey guys, how are you guys doing? Trust you're doing okay. How you guys doing? Okay, wonderful, wonderful. So we're just basically getting started. How are you having? If you had a nice day, this is David here. Um, Hi to everyone. I can see Mr. Chidi also saying hi. I can see and the Chinda saying hi. How are you guys doing? Just show me where it is that you guys currently are, and just kind of let me know where you are at the moment. So just tell me where you are. You can type it in. Just tell me where you are, where you're reaching us from. All right. Okay. Wonderful, wonderful. Hi, Prince. I think you're reaching Prince. You have to be from Ghana, right? Looks like it. It's wonderful, wonderful, guys. How is Ghana today? Yeah, I suppose so. You're from Ghana, yeah. How's Ghana today? Trust you're doing okay. Okay, from Port Harcourt. Wonderful, wonderful, wonderful. Okay, Mr. Samuel from Enugu. It's good to have you here. Good to have you here. So we're just basically going to try to give maybe like the next couple of seconds, really, the next 10, 20 seconds thereabout for a few more people because what we have got to share today is pretty interesting. And it's basically a problem that a lot of people have when you do technical analysis. Like I've gone like throughout our sessions, throughout our training programs, we always have people say, "Hey, whenever I want to check out the trend, I kind of understand what the trend is, but when I change my time frames during my analysis, it kind of gets confusing because I could see like a big trend, sort of like an uptrend on the higher time frame, but when I go to the lower time frame, it just appears like I just see something totally different. So that's basically what we're going to talk about today, guys. And that's basically what we're going to try to look at and try to see how we can solve, or basically how we can what we can what we all sort of like my advice would be considering how long I've been kind of doing this, what I think that you need to be doing if you want to succeed in technical analysis using multi-time frame analysis. Okay, guys. So I'm just gonna basically, for those of you who don't know me, my name is David. I am the founder and chief mentor here at Swably Markets. I've been trading for a long time. There's like you can find out more about me. There's a lot of information about my experience and all, but I don't want to really focus on that. I just basically want to focus on how I can help you to grasp a couple of the concepts that I think that will be useful. Okay, so before kind of getting into it, we should always talk about risk warning. Trading the financial markets got a lot of risk, and whatever it is that we're sharing will basically help you get more information about how you can manage that risk. But whatever it is that you hear here, it's not necessarily a solicitation. We're not soliciting that you. It's not a solicitation. We're not soliciting for you to. It's not an investment advice. It's educational, and hopefully, it can help you kind of understand better what um, what you need to be doing to succeed. But it's not a solicitation for investment. Okay. All right, guys. So what we're going to be talking about three areas. Okay. First, we'll be looking at the foundations of technical analysis. That's something very, very small. Like we'll touch on that. Then we'll look at the concept of fractals in trading. Then we'll look at the concept and application of multi-time frame analysis. Okay, this is really where we're trying to go into, but we kind of need to know a little bit about these two foundations of technical analysis and fractals in trading to really be able to understand application of multi-time frame analysis. All right, guys. Okay, so when we what we're going to look at in foundations of technical analysis, we basically look at what is technical analysis, look at a couple of guiding principles of technical analysis. Just as a very quick refresher, actually, there's supply resistance, uptrends and downtrends and indicators. I'm not going to spend a lot of time doing this because I believe that if you're here, you probably already know a little bit about this, but just for the benefit of those people who don't really know, I will do this, all right? Then I'll look at fractals in trading. I'm going to introduce you guys into a very interesting concept called fractals. If you've never heard about it, you will, if you understand this, basically, it begins to bring to life why multi-time frame analysis becomes very important. And in fact, I would dare to say that multi-time frame analysis probably gets to be like the most important bedrock of technical analysis, even more than the indicators, more than like a lot of those tools are. A lot of traders appear to want to prioritize. So you kind of hear a lot of traders talk about indicators a lot, and basically they don't apply it in terms of the context of multi-time frame analysis. So I'll talk about fractals, and I'll introduce the concept, talk about fractals of indicators as well. Then lastly, I'll just end up with telling you about the concept of multi-time frame analysis. How do you harmonize multiple views of price? How do you use top-down approach? How do you understand what your filter time frame should be, what your entry time frame should be, and how do you kind of take all of these and build it into a technical analysis canvas? Now, this is a lot, and we only got a very short space of time, so it's kind of like why I'm just basically delving into it. If you find out that you're busy along the way and you kind of cannot basically follow us to the end, we'll make sure that we have a video available for you, kind of like a replay available for you, and you can just go on and watch them. So if you're here and you're still here and just ready for us to sort of delve into it, just say, hi, I'm still here, and then I'll just proceed with my presentation. Again, I'll just proceed with the presentation. So just type in, hi, I'm still here, very much with you, stuff like that. So yeah, basically. Okay, so let's just delve into it. Let's just quickly delve into it. All right. So now when we look at technical analysis, the very foundation of technical analysis, this is a definition. I think I got this definition from investing.com, and it's pretty useful. Technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities. Okay, by analyzing, now this is what's most important, analyzing statistical trends gathered from trading activity, such as price movement and volume. Now, this is a lot of, it's a very comprehensive definition, but technical analysis basically means you're kind of looking at the price charts like this, okay? And you're basically, the price charts are basically, the price charts contain a lot of data. They basically contain the data of price plotted against time. So what that means is that what you have is, for any one asset you're trading, you basically would have had price moving through time. So for instance, this is the pound USD, and we can see that the current price here is about 1.3967 thereabout. But we have this chart that kind of shows us the historical sort of movement of price. Now, when we apply that to the definition of technical analysis, basically what that means is that we're analyzing statistical trends, okay, gathered from trading activity, such as the price movement. So every time that you see a trader coming on here to try to analyze, is basically performing technical analysis. Okay, so any trader that basically looks at the price of an asset and uses that to take decisions is practicing technical analysis. So that's kind of like a foundation that will get us started. Okay, and what are the principles of technical analysis? The first principle is that the market moves in trends, okay? Then we have another principle that says all information is reflected in the price, and also history tends to repeat itself. What does it mean when the market moves in trends? When you say the market moves in trend, what does it mean? It means that if you continue to study the behavior of price action, you kind of realize that for like stipulated periods of time, the market will move in a certain direction. So if you decided, for instance, to look at what we got here, for instance, to kind of like check out this portion of price. So just check out like this portion of price. It kind of gives you an average movement all the way up here. So this is kind of like a definition of, it's kind of like the interpretation of that definition, that the market moves in trends, and you're going to we'll find out very shortly what forms a trend. The very basics of technical analysis is about understanding what counts as a trend. So we'll find that out. But the first guiding principle of technical analysis is that the market moves in trends. All right. Now, another principle is that all information is reflected in the price. This is a principle of technical analysis. Now, the discipline of technical analysis, the alternative view of technical analysis is actually called fundamental analysis, wherein a trader is not just looking at price action, is basically also looking at like economic events, socio-political events, various sort of real life factors that are affecting the price of that asset. But as technical analysts believe that irrespective of what's going on foundationally, that the price will still reflect the total consensus of the market about an asset. I hope you guys understand what that means. It means that the price itself, irrespective of what the technicals are going on, okay, I'll give an example. So let's say, you have a particular country that's not doing very well, and the relative, the value of that country relative to other countries kind of begins to drop. Okay. Ideally, the technical analyst would believe that even that reward factor is still being reflected in the price. So long as, the technical analyst only needs to look at the chart and say, hey, I don't really know what's going on, but if I see that the value of this asset, the price of this asset, technically, like based on charts, is going up or going down, that's all the information that I need. So if you take a look at this asset, for instance, this current one, GBP USD, there are a lot of factors that could be responsible for this sort of rise of the dollar against the pound. So this sort of movement all the way up here, there's a lot of things that could be responsible for it. But as a technical analyst, the technical analyst basically thinks to himself that, hey, irrespective of what is going on, okay, the mere fact that I can see a trend here is saying to me that I can take a decision. So all information is reflected in the price, okay? And that's something that a lot of people usually struggle with, kind of, number one, believing, and number two, understanding that the price in itself becomes suitable in and of itself to be able to tell you what's going on, irrespective of what's happening on Bloomberg, or irrespective of what people are watching, or irrespective of what central bank governor is commenting, on and on like that. So another key principle, so this would make the third and probably the most important principle of technical analysis, is that history tends to repeat itself. So the whole concept of technical analysis, you basically are looking at frequently occurring patterns on the price and trying to figure out those patterns and use those patterns as sort of like a predictor of what the future is going to look like. So the principle of technical analysis, if you carefully study history will tend to repeat itself. So, and the charts are simply, they're a representation of price historically. Okay, so this is just sort of like a basic of technical analysis. I'm not really so much so supposed to be talking about technical analysis basics here, because what I want to talk about actually is multi-time frame analysis. But I recognize that you can't really talk about multi-time frame analysis if you're not, like, if you can't like just go into very short sort of introduction on what time frame technical analysis is. Okay, so in that spirit, let me just go quickly and talk about candlesticks. So you basically have bullish or bearish candlesticks. What's the difference between these two? The bullish candlestick will represent price, okay, when price is going up, and the bearish candlestick represents price when price is going down. Now, candlesticks are basically the building blocks of what the chart can be made of. There's other ways in which chart representation is done. You've got the line charts, you've got the bar charts, but the candlestick is the most popular because it shows a lot of information. We'll have in future a different session on how much information that the candlesticks actually show. But for this class, what's important to note is that you see the candlesticks, when you zoom in on the candlestick, you kind of find out that it contains something that looks like a box and like a line above and below the box. So in terms of explaining what that means, so your box here, okay, represents both the close and the open price of the candlestick, while the lines above represent the high and the low. Now, for people who don't know what this is, the close price, okay, simply represents the price at which the price at which that asset closes within a particular time. So this is where we begin to sort of get into time frames, okay? Because these candlesticks aren't just formed; they are formed in tandem with your time frame, okay? Like you for you to properly describe a candlestick, you can't do that without describing the time frame. So, and if you're new to MT4 usage, you're going to find the time frame here on sort of like the top up box. So the difference here between each of these time frames is that the M1 kind of says, kind of breaks down the chart into 1 minute. The M5 breaks down the chart into 5 minutes each, breaks down the candlestick into 5 minutes. The M30 breaks it into 30 minutes, on and on. D1 breaks it into daily and weekly and monthly. Now, these are just basic sort of concepts in technical analysis that really anyone should know. Now, again, this is a very short sort of snippet of a course that addresses something very specific. So I might not really be able to go into all of these details, like kind of foundational details. I think that we have like a free course that is just for this. I think it's called the early trading course that's recorded, so you can basically watch. It's got about 6 hours where we kind of break down all of this sort of basic stuff, but I'm just touching on it so that we have a reasonable foundation to get started with, to kind of move into the next level and talk about multi-time frame analysis. Okay, guys, so you really do need to understand that every time that you change your time frame, okay, it kind of does something to the chart and changes the chart. And the reason is simple, okay? If I'm on the 4 hours, it simply means that these candlesticks are made after every 4 hours, okay? Now, what that means is that you're going to kind of need like 6 of these 4-hour candlesticks to make a day, and that's because you have if you divided 24 hours by 4, you're going to have 6 candlesticks. So you need like 1, 2, 3, 4, 5, 6 to make a day. Okay, so if you're trying to sort of evaluate a day, you're going to need like 1, 2, 3, 4, 5, 6. Okay, to make a day, basically. So, but if this were like represented in a daily, you realize that all of this is this candlestick. So look at this candlestick. This is a black sort of bullish candlestick here because it represents price on the go up. Now, if you want to represent this one candlestick, okay, that's currently representing a whole day's movement. And what day is that? The 21st of June, right? If you look at it, you can see the date here, 21st of June. This bullish candlestick kind of represents the 21st of June. If you change your time frame to the 4 hours, you're going to see that this one candlestick is kind of broken down into 1, 2, 3, 4, 5, 6 other candlesticks. So look at that again. So on the daily, it's just one candlestick. But when you go to the 4 hours, it kind of breaks down that one candlestick into smaller fragments of time. So naturally, it just follows suit that as you change the candlesticks, okay, as you change the time frames, you're going to see like a different representation of how price behaves. This is what forms the problem of technical analysis for a lot of traders. So a lot of traders like, which should I look at? Because every time that I change this time frame, it kind of changes the view of price. All right. And usually, I mean, if you come into trading, the first thing anyone is telling you is the trend is your friend, know how to spot the trend, know how to look out for the trend. But then you have this situation where you, as you begin to change from one time frame to the other, you're kind of it gets a little confusing because you're asking yourself, what really is the trend? Okay, guys, that's really the problem that I'm trying to solve here. That's really what I'm looking at. Basically, just getting involved in, getting into. Okay, so yeah, I see our numbers are slowly increasing. I'm going to say hi to everyone. Hi to JC Kohler from AB. I think you deserve an award. You've been super active on our group. I've been thinking about you actually. It's a great job you're doing within the community. Prince again. So just saying hi to everyone. Okay, hi to everyone. So now, if you have any questions as we go along, just do well to just put in the questions in the sort of comment section. It's one of the advantages you have if you're watching this live. A lot more people are probably going to watch it later on. But if you're live, you can ask questions directly. Remember, this session is not entirely supposed to be like take you from the very beginning. Okay, this session is supposed to be try to help you understand how to solve one problem, which is the challenge that when you change the time frames when you're trading, everything just kind of changes. And if you're looking out for like what is an uptrend, what is a downtrend, and trying to take a position buy or sell, that kind of creates a confusing situation, right? And you're trying to see how you can, harmonize different points of price and change. So I'm really now kind of delving into that at this point. Okay, guys. So yeah. So right. So but let's kind of talk about what a trend is, okay? Like because at the end of the day, when you think about it, the whole point of analyzing that is to understand if you're on an uptrend or in a downtrend. If you're on an uptrend, you basically have successive higher resistances and higher support. Now, what is a resistance? Okay, a resistance is the highest point price gets to before it comes down, and a support is the lowest point price gets to before it goes up. So within a trend, you're basically going to have something that looks like this. You're going to have like resistance, support, and you're going to be having like successive resistances kind of rising. Okay, it's so the rule of thumb for when you're looking out for a trend is you basically want to see that every subsequent resistance is higher than the previous resistance. So if you look at this, for instance, this resistance here is higher than this particular resistance here, and this support here is kind of higher than this other one here. So you basically, this is like foundational sort of rule of thumb, check box for is it a trend or not. Okay, now remember that in talking about this, there's no mention whatsoever of time frame. Okay, like so what it means is that this sort of understanding of trend, you basically can use it to define a trend in any time frame. Okay, but again, that problem still remains, right? Like you can change time frame and everything just gets confusing. All right, so I'm going to get into that shortly, though. But a downtrend is the exact opposite of that. You have like successive lower resistances and successive lower support. So you basically see that resistances are falling and supports are falling, and this continues for a while, and then you can identify this situation as being a downtrend. Okay. So for technical indicators as well, like those are like mathematical tools that you use to forecast price movement. There's so many technical indicators. There's got to be like thousands of indicators out there. Each try to use our previous price action to perform a calculation and kind of give you a signal. All right. So you got like trend indicators. You've got like now trend indicators are like stuff that you can use to analyze current trends. The most popular trend indicator out there is the moving average. You can on every chart, even when you kind of open your MT4 by default, you're going to see it. Kind of looks like this. Okay, and the general principle around that is if prices are above the moving average, then it's on an uptrend. But again, the problem still persists because you just watch this moving average right now. You can see like this particular red line is the moving average. And we say, hey, if prices are above the moving average, it's on an uptrend. But if you're on the weekly and you look at this, you're going to see that price, for the most part, is above the moving average. Okay, but look at what happens when you actually go like really low to like lower time frames. You begin to see something different. You see that price is coming down, price is going up. So basically, for a lot of traders, this is super confusing, and this is really where we are driving at. And I'm going to arrive here very, very quickly so that this is the whole point of this. So we see from this that the problem you have when you're going through different time frames on the day on the like using normal price action. What is price action? When you're basically trading without looking at indicators. That problem is also still existent when you're using indicators. And by the way, this is true for every kind of indicator. It doesn't really matter whether you're using moving average or if you decided to go to any of the many indicators here. Let's say, for instance, you decided to go for like let's say you use the MACD as an example. If you plot the MACD here, if you notice, there's something about the MACD in terms of how the signal is red. You see these kind of lines here, this sort of ash colored lines. When they go below this center line or the zero line, as it's called, we look at that. The interpretation of the MACD is like that's a downtrend. Okay, but it's funny that when you kind of change the time frame, so this is showing a downtrend, okay, on the like the 5 minutes. But when you change the time frame to the 1 hour, you kind of see that it's a totally different signal altogether. So, and this is true for every indicator, and this is why like one of the big reasons why a lot of traders really falter if they're like, oh, I'm just going to trade this indicator blind. I mean, forgive my use of the term, but blindly, because you're not really looking at other things. That's a problem. Are you guys with me? That's a problem. So you realize that you can't just trust any one view of price, because when you look at something different, it shows you something different. And when you continue to go through like on the MT4, you got like 9 of these time frames. When you go through different time frames, you kind of get different views of price. That's problematic. That's a problem that you want to figure out how you're going to solve. If not, you're just basically going to be confused. What you want to do to make money is you want to basically find out, is it a downtrend or an uptrend? Okay, you want to find out either of these two. And the reason you want to do that is because clearly if it's an uptrend, you buy. If it's a downtrend, you sell. So, but you need clarity. You need to be able to be sure of what decisions you're taking. A little caveat, you can never be absolutely sure, but you basically want to be as sure as possible, okay, when you're doing that analysis. All right, so I'm slowly getting into the good stuff, okay, the good stuff. Now, when I started really studying multi-time frame analysis, one of the concepts I came across was fractals in trading, or like just generally fractals. So what is a fractal? And because if you understand what a fractal is, it helps you kind of understand how you need to be thinking about like trends, how you got to be thinking about multi-time frame analysis. So a fractal is a never-ending pattern that repeats itself at different scales. Okay, this property is called self-similarity. Okay, a fractal is made by repeating a simple process over and over and over again. And we can find fractals in nature and in math. So think about this. Let's think about this triangle. Okay, what you have in this triangle is you got like the pattern here in this triangle. Okay, from the sort of bigger view of it, you've got a triangle. But even as you go down, you begin to have like different smaller patterns of a triangle. So you can see another triangle here, and you can see if you consider this here, it's yet again another triangle. And you can consider this here is yet again another triangle. So you basically have like multiple triangles within one triangle. Remember, the definition is a never-ending pattern that repeats itself at different scales. Okay, self-similarity, that's the principle. So you get a simple process, then you repeat that process over and over and over again at different kind of scales. Okay, that's what you know as fractals. Okay, so let me show you how this works let me show you how this works in geometry, for instance, because the fractals in geometry is what's most applicable to price action, because geometry basically involves shapes. Okay, and when you're looking at a lot of price action has to do with the shape of the chart. So geometry, okay, factors in geometry now get to be more important when you think about it in terms of um, shapes. So if you notice that this tree here kind of branches out into one, two, three different branches. All right. But each of the branches itself kind of branches out into three branches. So this branch that came out of this main body of this tree itself branches out into three. Now, when you take this smaller branch, itself branches out into three, on and on and on like that. So we can see the how self-similarity is also being exhibited even here. So we have a situation where you got a simple pattern, but as you go to at different scales of it, you begin to have like different patterns. Now, how does this play out in trading? So how do you think about fractals in price action in trading? So you think about in technical analysis, trends cannot exist across different time frames. So trends exist within trends, displaying the fractal nature that's been discussed. I hope you guys are following what I'm saying. So if you think about this, when we define a trend, we say a trend is basically higher resistances and higher support. So here you have like a daily time frame, basically, and you can see here that you got an uptrend. You think about the area under this popule kind of like box, where the area under this popule box here. Now, if you're, this is what you see if you're looking on a daily time frame, but if you kind of go on a hourly time frame, you basically are going to see another trend. Now, this is what we mean by self-similarity, like the nature of price to behave, to repeat a certain pattern across different scales. So the daily is a higher scale as compared to the hourly. Okay, those are different scales. Okay, so if the trader is trying to ask himself what really is a trend, that becomes a very sort of tricky question, because now you're seeing a trend, an uptrend on the daily, and you're seeing kind of like a downtrend of the hourly, and it gets you wondering which one are you going to basically use. So that's what we need to be looking at right now. We're going to need to look at sort of top-down approach. Okay, I'm going to share with you how to effect multi-time frame analysis. Okay, so the problem here is that multi-time frame analysis often produces varying signals. So what is the solution? So you have to learn how to interpret price behavior across many views. And how do you achieve it? The first one is understand each trend for what it is. Okay, what does that mean? So rather than saying, for instance, that it's an uptrend or downtrend, you must learn how to apply context to your technical analysis. So, if, as an example, if I'm looking at this chart, for instance, so when I'm saying to me, when I look at this chart, I can say to myself that, hey, this is an uptrend, kind of, because you have all these sort of higher resistances. Okay, just a second, guys. Because you have this kind of higher resistances, you can see basically that resistances are rising around here. You can kind of see it, it's kind of very clear, because you have this resistance and you got this support, like, and you kind of have price behaving in that means. But I don't just say it's an uptrend. Okay, I basically have to say it's an uptrend relative to the daily time frame. Okay, it's important for you to apply context to your analysis. Now, when you say that, it gives you a sense of which view of price, or which scale you're on in terms of your analysis. All right. Now, so that's what you mean by applying context. Now, what you now have to do is to determine your time frame. Okay, you need to determine your entry time frame. Now, in talking about how you determine your entry time frame, because basically, if you're going to do multi-time frame analysis, two time frames that you would require, you're going to require your entry time frame, and then you're going to require your filter time frame. But before you begin to think about your filter time frame, you've got to know what your entry time frame is. So, and this is different for different traders. So I'll give you an example. If you're a day trader, which means 1 hour, or stuff like that. Basically, this is like the time frame that a lot of some day traders might even be using smaller time frames than this. But typically you'll be using like 30 minutes, 1 hour thereabout for your entries. Now, this time frame that you're using, okay, that you normally would like to use to trade is what you want to call your entry time frame. So after having that entry time frame, the next thing you want to do is to get a filter time frame. So how do you get a filter time frame? You basically have to have a time frame in an order of magnitude of 2 at least higher than your entry. What does that mean? So let's say, for instance, I'm a daily trade. I mean, I'm a short-term trader, like kind of like intraday. For those of you who don't know what intraday means, it means that you're basically getting in and out of the charts usually within a day. You're closing your positions before the close of that day. So I'm looking here at like the different time frames. Okay. Now, if I'm a daily trader, I mean, if I'm an intraday trader, my most favorable time frame will be this. But what this advice is saying is basically you've got to go to an order of magnitude at least 2. So you got this, my normal entry time frame. I've got to go to the 4 hour to the daily, which is an order of magnitude of 2, 1, 2 at the very least, to check out what the main trend is. So if I'm looking for a trend I will try not to oppose what I see on the daily. So as an example, let's say I want to enter into like a 1 hour kind of trade or whatever. I'm on the 1 hour, I'm looking for an entry opportunity here. I have to first of all go and look at what the daily is. Now, looking at the daily, I can see that, hey, okay, still does look like an uptrend. So I now come here and look for an entry. So whenever it is that you have found the time frame of that's comfortable for you for entry, you should always go to a higher time frame of at least an order of magnitude of 2 higher than your entry time frame. Okay. Now, what does this help you do? It helps you filter the noise. So it helps you understand what really is going on. Okay. I mean, if you get too close to the price action with that your particular entry time frame, okay, for intraday traders, 30 minutes, 1 hour, you are not going to be able to see the key information about the price. What kind of key information can you see? If you're not using a filter time frame that's higher in order of magnitude than your normal time frame, you will not be able to see what the key resistances and supports are. And that's just dangerous, because you might be on the 1 hour trading on a buy or sell or whatever, and then you don't realize that you're approaching a very key resistance or support from the higher time frame. Now, if that resistance or support holds, you're going to find a lot of momentum, against your trade, okay, which is just, can just help you lose money and stuff. So you really got to always look at the higher time frame. It doesn't really matter what asset. This is true for basically all kinds of assets. Okay, it's basically true for all kinds of assets. First thing is you got to determine what your entry time frame is. Then you got to go to an order of magnitude of at least 2, so you can basically see what the trends are, see if the price action is still correlating with the principles of rising resistances, rising support in an uptrend, falling resistances, falling support in a downtrend. You basically want to see that those things are still there, and you want to then go to the shorter time frame to evaluate your specific entry. Okay, guys, I hope you guys are following me. So this is really the thing. And again, like I've said, it helps you see your main. Another thing is, if you're using like your filter time frame, which is an order of magnitude of at least 2, make sure that that's the time frame that you begin to plot your resistances and supports from. So I'll give you an example. Let's say, for instance, my entry, where I wanted to have entries on the 30 minutes. Okay, let's say I'm an intraday trader. I'm kind of looking out for entries on 30 minutes. I'm going to go to an order of magnitude of at least 2. And it's from this place, this 4 hours. Okay, you look at what I'm trying to say here. Basically, I want to enter on the 30 minutes. So I'm saying to myself that I have to go with at least an order of magnitude. I'm supposed to start here. Okay, I'm basically supposed to start here. but I'm going to go 1, 2 to an order of magnitude of at least 2 to evaluate what's happening. And that's exactly what I'm going to do. So, and it's from these places I'm going to plot my resistance and support. So a lot of traders, one of the big mistakes that a lot of traders do when they're doing technical analysis, you start to plot your resistance and support from your entry time frame. That's not cool. You should look at time frames higher than your entry time frame, and that's where you should start plotting your resistance. So I'm going to be looking at, oh, this is a key resistance here. I'm going to plot another one here, stuff like that, another one here, kind of like that. And I look around price action, and I say, okay, well, what other resistance and supports are there around price action? Then I can now kind of go and begin to see them. You get what I'm saying? So if I'm on the 30 minutes now, then I can more easily see that, hey, there's something going on here. Okay, and that's just basically the best practice for it. Okay, and as a general principle, okay, you want to start your analysis, your view of price using a top-down approach. You've got to first of all look at the higher time frames. You've got to look at what the behavior, what the sentiment of the market is at the higher time frames. When you understand that, okay, when you can get a form of understanding of what's going on in the higher time frame, then you can zoom down. There's something I usually advise a lot of people to do, and I do it all the time. I'm going to share that with you. So, because within a trend, okay, I want to just show you guys a little, so like something simple. Within the trend, there's always there's these places that's easier, sort of like demand and supply areas within a trend, where you basically you basically will find that you want to. So let me show you guys this. So basically, if you're observing an uptrend, okay, an uptrend is simply rising resistance and rising support. You kind of notice that the areas in which you there's a lot of demand, okay, where you can basically buy, will tend to be around these areas. These are the areas that, if you can find these areas out, these are the areas where like you kind of like have a lot of demand. Okay, so such that the next time the price is even coming down towards an area like this, you kind of already know that somewhere around here there's going to be like increased demand. And of course, I always advise people to buy. So I always advise people to you basically got to buy around demand zones, okay, areas where there's a high likelihood that price is going to rise from. So I'm going to save this up quickly, and I'll compare that with. I'm going to assume that this is a higher time frame, and I will compare that with how I think you should be behaving if you saw, if you went to the shorter time frame and you saw something different. Okay. So I want to help you guys compare this with. Let me help you guys compare this. Okay. I just want to show you guys something real quick here. Got the higher time frame here. Okay, so let's say you have this. Okay, so this is kind of like your higher time frame, and you have this. So as I mentioned, you've got to always seek to buy here, but when you're doing this, okay, this particular fractal that you're looking at should be on the higher time frame. Okay, now if you decided, if this were like the daily, let me give you an example. Let's say, for instance, this is the daily, this is a daily view. So okay, so this is daily time frame. Okay, if this were the daily time frame, and you now wanted to go into like the 1 hour for an entry time frame, I'll give you an example of how you can combine both of them. So let's say if this is a daily time frame, you likely will have that because of this sort of correction here, you have a full-blown kind of downtrend on the shorter time frame. And that will kind of look something like this. I hope you guys are following what I'm saying. You're gonna have something that kind of now looks like this, which is basically opposing what you had, okay, what you basically had here. Do you understand what I'm saying? Now, one thing that you can do when you're looking at the shorter time frame is to maybe use such simple tools as a trend line, such that, and you can now use such tools as a breakout of a breakout on the upside, okay, as being what will trigger your trade. Now I'll explain this a little bit in a little bit more detail. Okay, so you guys just follow me. I'm going to explain this in a little bit more detail. So basically, you will be looking at more than just one view. Okay, the higher view is what informs your initial bias. So your main bias about what you really want to do should be formed from the higher view. Okay, so as I explained here, this is your daily time frame. So let's say this now gets to be your like hourly time frame. Okay. All right. Yeah. So now, my advice to people whenever you're analyzing trend, after understanding that, okay, this is actually a trend, I usually advise you should look to buy around basically demand areas. Demand areas are areas where price has corrected, it's made an impulse move, it's got a correction, then in and around that correction, there's a high likelihood for it to push towards higher levels. Now, if you see this kind of a demand area, when price is pushing to this kind of demand area, on the shorter time frame, what you likely would see will be a trend. Okay, so that's why I'm like kind of representing this as a downtrend. So you got the main uptrend, then you got this particular correction here showing itself kind of like as a full downtrend. Now, in terms of how you combine both information on the upside, shorter time frame. So basically, you already have a sense from your higher time frame that this entire area is a demand area. So when you go to your entry time frame, you're now basically looking for an opportunity for price to break out of that down trend. I hope you guys understand it. So in fact, even though what you're seeing on different time frames is different, you can take one harmonized view of what you're going to do. First of all, your main bias, okay, and this is just a couple of rules. Understand that your main bias should come from your filter time frame. Your entry should now be a function of the shorter time frame, but it has to be in the direction of your filter time frame. So you don't kind of come on your shorter time frame and say, hey, I kind of see that the price is coming down, so I'm going to sell. No, you don't do that. It's always bad because you've got more data on the higher time frame that supports that price should be rising. So if you're going against that, you're basically going against more price data. Not very smart thing to do. Okay, so it always makes sense for you to whatever you take your bias from the higher time frame, your main bias from the higher time frame, okay, and then your entries from the shorter time frame. So if you look here, for instance, even if you see the price coming down, from here, you can say to yourself, hey, I'm going to wait for this price to break out on the upside in order for it to continue this uptrend. And remember, this uptrend that you're seeing here has come from the higher time frame. It's a continuation of the prior trend from the higher time frame. So a rule of thumb, always make sure that your bias comes from the higher time frame. How do you get the higher time frame? You got to first of all know your entry time frame as a function of what kind of trader you are. If you're a trader who's an intraday trader, your entry time frame should be on the shorter time, like 30 minutes, 1 hour, those type of time frames. All right. So you got to first of all go to the higher time frame, 4 hours daily. Then understand the main bias. Okay. Understand now what I mean by bias is the market in a demand or supply area. That's the true meaning of bias. If the market is in a demand area, you kind of understand that very soon there's a likelihood. So, like I mentioned to you, from the higher time frame, you kind of see that, okay, demand area, demand area, demand area. So you begin to understand that, okay, very soon there's a likelihood that in and around this zone where price is, there's potential based on previous price action for price to rise. Okay, so then you now position yourself on the shorter time frame to join that bias. You don't trade against that bias. So it's kind of contrarian and it's a little bit counterintuitive because people don't really think about it that way. A lot of people kind of think that, okay, well, I want there to be an uptrend on every single time frame. It likely wouldn't be that way. Okay, but you can harmonize all of the views. Okay, and I hope that that's kind of you kind of understand that. So if you want to basically get a summary, the best way for you to do this is to sort of take a top-down approach, understand what your filter time frame and your short time your entry time frame is. Remember that your entry time frame is a function of you. Okay, somebody who is a doctor, for instance, who got a job that means that you have only a small amount of time to spend on the chart. By default, you'd likely be a swing trader. Okay, so you probably be able to enter into trades and leave it on for like a number of days or maybe even a couple of weeks. So your entry time frame will probably be high, will definitely be higher than somebody whose entry time frame is who's entering into the trades every day. I hope you guys understand it. So naturally, if that doctor person has a higher entry time frame, it also means he's going to have a higher filter time frame. If his entry time frame begins at 1 hour, his filter time frame is going to begin at the daily. If your entry time frame begins at 5 minutes, some people do that. I don't recommend it, but certain people do that. If you 5 minutes, then your filter time frame is going to be like 15 minutes or thereabout, or like 30 minutes. So that's basically like my thoughts on multiple time frame analysis. I hope you guys found that useful. So so now listen, guys, you can ask your questions. Now you can, if you have any questions, you can just put in the questions. Somebody's saying here that is there any time frame that is best for checking resistance support? As a rule of thumb, you should always use your higher time frames. Remember, you as a trader, you know what kind of trader you are, basically in terms of are you a short-term trader? Are you a swing trader? Are you a long-term trader? Most retail traders aren't actually long-term traders. Most retail traders Okay, so I was answering that question about the best time frame for checking resistance and support. Listen, I'll just give you a couple of rule of thumbs. Okay, the higher the time frame, the more important the resistance is. But you also don't want the support is. But you also don't want a situation where you're so far away from you're basically so far away that you from your time frame that you don't it doesn't make any sense. So for instance, somebody who's doing entries with 5 minutes, 15 minutes, if you're looking at the weekly resistance and support, that doesn't really make a lot of sense because it's so far away, because your entry time frame is so far away from your filter time frame. So you want, which is why I kind of advised you want to have your filter time frame, you want to have your resistance and support from the filter time frame. Okay, guys, and your filter time frame should be in an order of at least 2 higher than your entry time frame. Your filter time frame should be in an order of at least magnitude of 2. Let me quickly share my screen and basically try to explain that in a little bit more vivid way, so you kind of get it. Now, so if you're a trader and you trade with 15 minutes, okay, your entry is normally on 50 minutes. What I'm trying to tell you is that your filter time frame, where you should be taking your resistance and support, first of all, is from the 1 hour. So it's also from the 1 hour you begin to analyze the trend and know your demand and supply areas. So you don't start analyzing the trends on the 15 minutes. No, you begin from the filter time frame because you're looking at the intermediate sort of trend at that point. If you're on the 30 minute, if your entry is on the 1 hour, you're like basically you a lot of times when you're trading with the 1 hour, okay, and you're like maybe a short-term trader, something like that. you want to begin to do your filtering, okay, your understanding of the trend and the bias from the daily. So you do your demand and supply areas from the daily. It is also from the daily that you plot out your resistance and support. Then you now basically, if you understand the demand or supply area, you can come down to the 1 hour and then you now get you plot, and then you also know what demand and supply areas are. Then you come back to the lower time frames and you basically kind of get into your entry. Okay, guys. So that's basically it. Now, okay, somebody saying nowadays you hardly find trends. That's well, we do still find a couple of markets trending, but hey, the most important thing that you got to know is, irrespective of what asset you're looking at, irrespective of what asset you're looking at, you got to understand that structurally, okay, if you look at, especially if you're looking through that time frame, there will be a demand or supply area. Okay, there will be a demand or supply area. If you find that demand or supply area, then you can come down to your sort of shorter time frame. Somebody saying, okay, what is the situation where price is ranging? Now, remember, guys, there's totally different strategies that you can use for ranging markets, but it's always better to trade when the market is trending. Like when the market is trending, there are a lot of assets on the charts. It's always better for you to trade when the market is trending. If you have ranging markets, then you begin to look at strategies for sort of counter trend strategies. You know, I most of the time prefer not to sort of counter existing trends, but if you absolutely must, then you have to be a little bit more. You have to make sure that we have like other strategies that we use for counter trend. For instance, if for those of you guys who have been in and around our sort of trainings, you realize that there's a way in which we kind of know when a particular price is overextended from a particular benchmark. That benchmark could be a moving average. So we have certain tools. One of the tools is the PPO. PPO is great for kind of telling you to what degree of percentage price is overextended from a benchmark moving average. So if the price is significantly extended, then it begins to give you more confidence that you could counter trade, that you could basically reverse the trend trade. Okay, so we share more about this stuff on our PMI. Okay, so guys, it's already 8 o'clock. This was meant to be like 1 hour. I'm going to give you two more people like an opportunity to ask questions. If there's, I'm going to see. All right, if there's any question, but if there's none, then we're just going to close. And remember, like, we have a Discuss community on the Swavely group, and that Discuss community, you basically can come on there and ask your questions or interact with us. We've got the PMI, which is basically going to be something like this. We're going to be doing this instead for like 2 hours. We're going to do like it's going to be starting like in the next 1 week or thereabout. We're going to be doing this, something like this, for like 3 times in a week. And we're going to touch on so many things. I can't really go into everything we're going to do, but we're going to go into strategies. We're going to go into multi-time frame analysis. We're going to go into how you can pre-plan volatility. We're going to go into, there are a lot of concepts that we're going to look at. Various trading strategies, commitment of traders. Commitment of traders report, the COT report, where you can find that, using confluences, using what tools that you got to know if you want to be a pro trader in terms of risk management, your cumulative exposure, risk of ruin, your risk per trade. We're going to go into correlation and diversification. We're going to go into strategy optimization, so many things. And on top of that, I have a library that has about like over 60 videos that contain, it's a course in its own. It's called the Requisite Trading Course. Some of you here might be taking that course right now. It's got over 60 videos, several strategies, sort of live strategies so you're going to get access to that, plus all of this over the next 2 months. Okay, I'm super excited to see some of you guys up on that program. It's like a little family. It's not like, we usually don't seek to have a lot of folks there so that we can so I'll be looking forward to having you guys there. For those of you who will be getting on the PMI between today and tomorrow. I'm going to give you a special discount of 10% for that. It allows you to, which means that 10% is off if you're going to be making payment between today and tomorrow. If you're within our community, just speak to the admin or just go to the Telegram channel and ask to chat with the admin. Okay, and somebody is going to reach out to you. It's been a lot of fun, guys. It's been a lot of fun. Remember, like, no matter what you do, now all of what we've talked about today has been analysis. Always remember that that's not all that makes a good trader. I always say that to be a good trader, you need analysis. Okay, you need psychology and emotional management, and then you need strategy. So your technical analysis is not all; it's just 33%. Nobody ever gets an A with 33%. So you've got to be able to do other things, and we kind of help you in that journey. We're starting the PMI end of this month, and I'm super looking forward to having you there. So somebody's saying, can you stream later from? I don't get what this. Yeah, so yeah, this is a stream, so you can go to our Swabely's YouTube channel and watch this and many other things. Like, go on the YouTube channel, you're gonna find a lot of things, okay, on there. And we want to welcome your feedback, okay? We want to welcome your feedback. So this is bye from my side. Thank you guys for joining from Nigeria, from Ghana. Okay, I'll be looking forward to seeing you guys the next time we're going to do this, all right? Take care, guys, and bye for now.
Proud to know, guys.